So I'm going to focus just on the U.S. economy and the market in which we invest, which is the U.S. multifamily housing market in the southern states. All right, job drought, debt hangover, deleveraging, the banking collapse, you can go on and on about the negativity. And it can get quite confusing and quite complicated when you try to analyze it. But as I'll try to show you in a few slides, we think it's relatively easy to understand. Not all positive. There are some bright spots, though. I think when we look back in time, 10, 20 years from now, we'll look at this period and conclude that it was a depression. It was a 1 in 100-year event. I'm going to show you a slide where you can actually look at it as a 1 in 600-year event and not your garden variety recession that tends to happen once every decade. But when I said it was relatively easy to explain in terms of what was the cause of this financial crisis, at least in the States, it all comes down to demographics. So this next chart, you can take it for what it's worth. For me personally and for our own firm, Ventura Realty, this is the single most important piece of investment information that we've used to guide ourselves over the last decade, and it'll certainly be the most important over the next decade. This is worldwide population growth. So you can see in 1970 or so, it was about 2%, the growth rate. And it's been on a steady decline out until 2010, where we are now, which is at 1.15%. About 2018, it's going to dip below 1% and then steadily decline until the middle of the century. What's interesting is that if you really look at our modern form of capitalism, you know, as much as we'd like to think that innovation and inventions have a step function improvement in productivity and living standards, there are only so many fires and wheels and penicillin and printing presses or internets that come along. By and large, we're still, for our standard of living, are dependent on having, you know, more heads over which to put roofs, more backs to put clothes on, more feet to put shoes on. And we're not so good at, you know, coming up with these innovations. And it's interesting that if you look back in history, the last time, and don't forget, 2018 as indicated there, we're going to dip below 1% worldwide population growth. The last time that happened was when the Great Plagues hit Europe in the 1200s and 1300s. So that's why I say, at least from a demographic perspective, it's actually, you know, a 1 in 600-year event. And you could say, well, that's very interesting, but not relevant, because for the last 40 years, since 1970, we've been having declining population growth with no apparent ill effects until 2008, and everyone realizes we hit a wall then. But the reality is, every recession that we've had since 1970 has not recovered without the help of government intervention and asset inflation by the governments and increased debt. And so every time there's been a recession, the government's taken on, at least in the States, taking on more debt to the point that's doubled the debt relative to the size of the economy. Because we as consumers or voters are expecting 3% GDP growth, because that's what feels good to us, and we expect it of our politicians, and they try to comply, but organically, the economy can't produce it. And that's why we ended up in this mess. We weren't growing on our own volition up until now. Now, one of the consequences of that, and again, it's not all negative. There are opportunities to invest and to make money. You've got to be careful. You know, we follow the premise that you've got to have capital preservation first, income generation second, and if you can get capital gains, that's great, but don't compromise on those first two principles to get capital gains. Now, one of the consequences of this demographic issue that I've talked about is debt. And no matter how you slice it, you can slice this a whole number of different ways, you come back to the same conclusion every time, and that there's too much debt in the U.S. economy, and there has to be deleveraging that goes on. So if you look at the far end of this chart, there's a little dip right there. That's the amount of deleveraging that's happened in the last 2 years. As painful as it's been a 1% reduction in the non-federal debt that exists in the economy. And so you could say, well, you know, what's normal? If you take normal as the 1990s, that would require that we do 30 times the amount of deleveraging that's already gone on. If you say normal is more like the 70s and 80s, it would take 40 times the amount of deleveraging that's already gone on. So when you hear an economist say, well, this deleveraging has been difficult and it's going to need another year or two and then we're going to be back to normal, try 2 decades. Okay, I said this was the most important chart or piece of information that we use for investing. This next chart is the second most important chart, and it's more positive. The first chart over here is worldwide population growth. The second chart is population growth over the same time period to 2050 in the US. And what's interesting about this is that the average compounded annual growth between now and 2050 in the US is expected to be 0.8% per year. Not nearly as good as the growth that we've experienced in the US over the last number of decades, but nevertheless, by far, the fastest growth rate that we're going to see in any developed country in the world. And in fact, that 0.8% growth rate, if you take the midpoint between now and 2050, which would be 2030, the overall world is going to grow somewhere about 0.7, 0.75% per year. So the States is actually going to grow faster than any developed country, but faster than the rest of the world on average as well. And if you take the markets that we're focused on, which are the southern United States, they're actually going to grow at closer to 1% per year on average to 2050. So substantial outperformance. Okay, these are the assets that we invest in. These are actually pictures of properties from our portfolio. I put them up here because these assets tend not to exist in Canada. If they do, they're like garden style. They're called garden style apartments. 300 units, for example, spread over 20 or 30 acres, 1 and 2 stories. If you see them here in Vancouver or in Toronto, they tend to be individually owned townhomes and condominiums. But here, they're a collection of apartments that we own centrally, just like a high-rise that you have here, but it's spread out. Okay, so there's a lot of positive trends that give some tailwinds to investments in multifamily in the southern United States. One of them is demographic, echo boomers. Echo boomers are children of the baby boomers. They're people that are 25 to 29 years of age, high propensity renters. That age bandwidth is going to increase by 2.5 million people over the next couple of years. There's deleveraging that we talked about. The end effect of that is pushing people out of owning a home into renting. And then there's a substantial, which I'll talk about, pullback in construction of both single family and multifamily in the US. This all leads to projections that there's going to be strong rental income growth for apartments in 2011. The reality is the markets that we're in, and I'll talk about this, are already experiencing very strong our rental price increases, even though the economy is still relatively weak. Interesting, there's a structural shift that has gone on. I think it's really fundamental in the US in terms of attitudes toward housing. So the University of Michigan study indicated recently that a whopping 2% of the people in the US feel that a house is a good investment. I don't know what it was during the boom, but it was multiple times higher than that. And then as John alluded to, the home ownership rate is changing. So the current rate of about 67.5% is much closer to the bubble peak of 69.2% than the norm before the bubble of 64%. And it's important to note that every time that home ownership rate declines by 1 percentage point, that's about 1.2 million more units of demand or apartment units of demand that are coming to the marketplace. And interesting, the Urban Land Institute believes that by the end of this decade, the actual home ownership rate is going to go to 62%. And Dr. Richard Florida, who is actually an American teaching at York University who studies this market, believes that the home ownership rate is going to go, in the States, is going to go down to 55% over the next decade or so, basically because that's what's economically viable. And when you have a market where no one has any money, the government's got nothing in the cupboards left to prop it up, economic reality will be the order of the day. So we anticipate some substantial erosion in the home ownership rate, which means a whole bunch more people getting pushed into rental units. And unfortunately, income distribution in the States isn't like it is in Canada. It's much more dramatically skewed. In addition, it's very difficult now to get a mortgage in the States relative to before. You actually have to have a down payment, which has always been the case in Canada. So there's a much larger, what we call renter by necessity demographic, which again is pushing a lot more people into rental accommodations. There's a once-in-a-generation change occurring in the supply-demand fundamentals within the apartment community. And it's currently going on. So this chart talks about inventory or the total stock of apartments in various cities. So I'm just going to take Austin, Texas, for example. So in the last 18 months, that's this blue column right here, the total inventory of apartments increased in the last 18 months by 7.2%. It's quite large. Over the next 18 months, it's going to increase by 1.3%. And if you look at the US apartment market as a whole, each of the next 2 years, they're only going to bring about 50 basis points or a half a percentage point of new stock to the market. That barely covers the rate of obsolescence, i.e. the number of apartments they raise level to the ground because they're not habitable anymore. So you literally have, for all intents and purposes, no new apartments coming to the marketplace over the next 2 years. And that's why you don't really need a lot of job growth or a strong economy for apartments to do very well. And in fact, I believe you could have zero job growth in the United States and still have rising demand for apartments. Why? Because the reality is that you've got 10% of adults under 35 years of age have moved back in with their parents. Another 12% have taken on a roommate they didn't want in the first place. 14% have delayed getting married, and 15% have delayed having a baby. So you've got all this unnatural behavior that's waiting to get decoupled. And in fact, we think it's already happening because we can't explain the strength that we're seeing in our apartment communities in terms of demand just based on the relatively weak job growth that we've been experiencing. So the apartment demand is generally stable. We had a significant employment decline in the States that we didn't have here. So total employment peak to trough went down by 6%, yet we only lost 150,000 renters, or 1% decline. Pricing had to be compromised in that regard, but it's coming back very strongly. Investors are looking, they're thirsting for a market that has even a whiff of inflation, because in the States there's a lot of deflationary pressures, and our market has it. If you take our total portfolio of 11,000 units, and you take the average that the people that are occupying those 11,000 units have paid for the rent, and John Smith shows up today at one of our apartments, he's going to pay 3.5% more. So marginal pricing is up 3.5%. And I would argue there's very few industries in the States that are experiencing that kind of pricing leverage. Okay, so our multifamily transactions, how do they work? First of all, we have very high risk-adjusted rates of return. What that means is that you can find other investments with higher rates of return, but you're going to pay a disproportionately higher amount of risk to earn those rates of return. Cash flow is immediate and high. You don't need to achieve capital gains in order to have the investment do relatively well. The cash flows are strong and they stand on their own. Here's an example, a sample of a deal called West End Lodge. We currently have this property under contract and are in the process of finishing the due diligence. It's located in Beaumont, Texas, which is an hour east of East Houston. So cash flow, 7.8%. So that means that if someone put $100,000 into this deal, they'd get $7,800 back in their first year, spread over 4 quarterly payments. Return on equity is simply the difference between cash on cash and the amount of loan amortization that you're paying to reduce the loan balance. And that's, that you get that money back at the end. And IRR is the total return per year, which is just basically the difference between the return on equity and the anticipated capital appreciation. This is a 2007 built asset. And the last time I looked, and I do look, trying to achieve those kind of cash-on-cash returns in buying a brand new apartment in either Toronto or Vancouver were not possible. Okay, so how are these returns possible, given how high they are? First of all, the right industry, right? Demographic trends going in favor of apartments, supply-demand fundamentals changing, financial distress in the States that's going to go on for quite a while, pushing more people to renting versus buying. The right markets, I'll get into that in a minute. Local improvement acquisition team. We've got people based in Texas and in the southeastern United States, and they do nothing but scour the market looking for deals. And in fact, we do 80% of the transactions that we complete are off market, meaning that they're not marketed broadly through a broker network in a traditional means. And how we're able to achieve that is based on the reputation that we've created over the last decade. Oftentimes, a deal will fall out of contract. It'll fail. Or an owner is facing imminent foreclosure if they don't get a refinancing complete, but they don't have the capital to do a refinancing. And so they go to their broker and say, get me a buyer who can complete a deal. And price becomes less the objective, or trying to optimize than just getting a deal completed. And that's how we end up having pricing leverage from a buyer perspective. We have an industry-leading operating capability, which I'll talk about in a bit. Importantly, we buy these properties and manage them as if we're the owners because we put our own capital into every deal. And lastly, based on my experience, nothing adds clarity to the decision-making process when you don't need to do something. And we don't need to make acquisitions. We're a profitable organization. We could not make another deal for 5 years and would still be profitable. We make more money if we do deals, but we don't need them to make money. Okay, these are the markets that we're in, 11 markets throughout the southern United States. I'm going to go in a little more depth than that. Okay, it's interesting. People hear the markets that we're in, they naturally conclude, well, it makes more sense to be in those markets than, say, Cleveland, Ohio, or Buffalo, New York, or Erie, Pennsylvania, because those are in structural decline. But what they don't fully comprehend is how much stronger our markets are than the national average in the U.S. or other high-profile Tier 1 markets such as Chicago, Los Angeles, and San Francisco, which we've not invested in. So this chart shows job growth year over year. August 2010 over 2009. You can see relative to those other high-profile markets, the job growth is dramatically higher. And interesting, when I say that our markets hog jobs, they do. In this last recovery, 2009 to 2010, we have Texas actually took almost 50% of the jobs created nationally. That's another reason why we don't need a lot of strong job growth in order for these investments to do well, because, again, our markets get a disproportionate share of those jobs. Okay, so operating capability. My partner and I have a software background. We've aggressively automated over 50 business processes. Our strategy has been to centralize, automate, take as many activities that are non-sales and marketing out of the property's hands and let them focus on retaining our clients and attracting new residents. I call it the Walmart effect. Looking at one of our communities doesn't look very difficult to manage, but it's seemingly complex. The same as Walmart store is complex to get that product to you at that price in a consistent manner. The way we've automated has allowed us to do things that very few other real estate firms do from an operational capability. First, every property manager and every regional manager gets a performance review every quarter. And every other on-site personnel at any property, whether it's a maintenance manager or a housekeeper, gets a review every 6 months. And every one of those reviews is differentiated. So it's top 20%, middle 70%, bottom 10%, and the person getting reviews gets their results. We also have a 48-hour work order guarantee. That means that all of our residents, when they put a work order in, if it's not fixed in 48 hours, they stop paying rent until it is fixed. Great marketing tool, but you can't offer that unless you have tight control of your operations. Less than 1% of the real estate firms out there are offering a 30-day moving guarantee. So basically, we're in the leasing process. We offer our residents the ability to break their lease in the first 30 days of the lease at no cost for whatever reason. Again, a great marketing tool. It helps us attract clients, but you can't do it unless you're on top of your operations. What does it all result in? It results in better results. ApartmentRatings.com is a very important site where prospective residents look to see what apartment communities they want to live in. It's rated by existing residents of a community and previous residents. Our overall portfolio has an average of 73%. Our competitors' average is 46%, a dramatic difference. One of our major institutional equity partners is General Electric. We currently have 17 properties that we've jointly invested with them. They recently asked us to do a portfolio review based on occupancy and on effective pricing year over year, I should say. Versus the competition, 3.3 percentage points higher in occupancy. Versus pricing, 7.3% higher. GE is just launching another real estate equity fund. Their investment committee gave them approval to hire the 5 best partners that they have out of the 100 plus that they've partnered with over the last decade across all of North America, across all real estate asset classes. So multifamily, office towers, retail, warehousing, industrial, et cetera, and Venterra is one of those firms. Okay, so in summary, we can do well in this investment even if the overall U.S. economy just has mediocre performance. We can do well without relying on capital gains because the underlying cash flows are very strong. Deleveraging and increased consumer savings, which are rippling through the economy and are going to be with us for a while in the U.S., as I mentioned, actually feed more people into renting and help with our demand. Baby boomers, echo boomers, immigration, and one of the things I didn't mention, I don't think I mentioned it, the 100 million people that are going to be coming to the States over the next decade. The majority of them are going to be immigrants. Where do immigrants tend to settle in the States? In the southern states, in our markets. What do immigrants do in terms of living patterns? They tend to rent in the States for 10 years before they buy their first house. And certainly with this economic turmoil, it's going to be a longer period of renting than 10 years. All of that feeds into supporting this investment. The bloom is certainly off. The home ownership rose, and the stigma of renting has declined dramatically in the States. We're in a once-in-a-generation supply dearth. This market has inflation like few other markets. The level of Canadian dollar that John talked about, I can show you graphs that, because the rates of return are high in these investments, that if you hold them for a long period of time, the level of the Canadian dollar fluctuating doesn't have a material impact the longer you hold the asset. But all else being equal, if you can buy at 98 cents versus 68 cents, it's better. And importantly, this is not an experiment for us. We've done this about 60 times, buying and selling multifamily properties, so we're not babes in the woods on it. we're very confident in our ability to meet the projected returns that we have for any prospective acquisition that we're going to do. So thank you for your time. I'm going to turn it over to Wayman.